Hello, I'm Brian Rezny, president of Rezny Wealth Management. I'm bringing you a show today about the investment markets and your investment strategy. One of the questions I repeatedly get on my TV and radio shows is about how do you develop an investment strategy? Is my broker or so-called advisor really managing my money? How do I know the difference, and how do I protect my portfolio from catastrophic sell-offs in the stock market, the bond market, real estate, or gold? We're going to talk a lot about real investment strategy. In fact, today's title of our talk today is Real Investment Strategy, so you can make better decisions and develop an investment strategy, or if you don't have the time or maybe the want to manage your own money, you'll know exactly who to look for that can actually manage your portfolio, which includes risk management. You know, there's unfortunately many investors out there who falsely believe that their advisor or broker, either at their Wall Street firm or their broker-dealer or at the local bank or the insurance agent, is actually responsible to manage your money. And unfortunately, these people actually don't manage your money at all when you're inside a brokerage account or when you've been sold an annuity or other proprietary products. At the end of the day, a strict investment strategy, which includes risk management, is going to be more important than ever because most investors can handle little bumps in the road. What they want to do is they want to make sure that they have a way to eliminate those bigger catastrophic downturns in the portfolio like we saw in 2000 and in 2008. Unfortunately, most investors have what's called a buy and hold strategy because, again, they feel that their broker or so-called advisor is actually managing their money. But again, if you're in a brokerage account or in some kind of an annuity or general investment plan, that generally is not managed money, and the broker or so-called advisor is not actually managing anything. They're actually selling you investments that their firms represent and market. What is your investment strategy? One of the things that you want to think about as an investor is this. If you do develop your own investment strategy, or if you entrust somebody to manage your own money, you want to make sure that you understand what that investment strategy is. If you're managing your own money, you need to develop your own strategy and backtest that strategy to see if it was effective over multiple market conditions. While that's not a guarantee to the future, at least it gives you a good indication if your strategy has worked, and it'll give you an indication that there's good probability that it may continue to work in the future. If you're working with a firm, what you want to do is ask them for a written copy of their investment strategy. Any real money management firm, like a firm like Rezny Wealth Management, should easily and clearly be able to hand you a copy of their investment strategy, which basically reflects and defines exactly how they manage the portfolio, how they buy and sell, what they buy and sell, what are their criteria around managing that portfolio for not only upside in income, but for downside risk protection. How do you control risk and when to sell is an important part of any investment strategy. This is really the crux of the problem. Most do-it-yourself investors spend more time buying investments, but they don't know when to sell because truly they don't run an investment strategy, which includes when to sell or risk management. The same thing happens when you're working with a brokerage firm, a bank, or an insurance company, because most of these firms actually do not manage your money. And again, most investors are in what's called a brokerage account, and in a brokerage account, you, the investor, are responsible. So when you go through periods like 2000 and that recession, or in 2008 when we had the next recession, most investors thought Mr. Advisor or Mr. Broker was actually going to call you and say, hey, we need to sell some equities because we're going into recession, and typically in a recession, equities do poor. Or real estate is grossly overvalued and you own real estate investment trusts in your account and we need to sell those before they drop 50 or 60%. Or like maybe the bond market, if interest rates go up, bond values go down. Are you going to expect a call from Mr. Broker then? Probably not. So again, how will you control major risk in your portfolio, and when do you start selling an investment when it's appropriate in order to control those major catastrophic sell-offs that often go down 30 to 50% and often for prolonged periods of time that often take between 12 and 18 months before they actually bottom. Most investors rely on Wall Street firms or advisors who actually do not manage your money. I can tell you, I've been managing money for 28 years. The majority of the new clients that hire my firm thought that the person at the local bank or the insurance agent or their broker was actually responsible to manage their money. Again, in a brokerage account, that is not managed money. You are responsible to manage your own money and develop your own investment strategy. The comment I often get is, he told me to hold on, things will come back. That is a for sure sign that you're dealing with a broker or a so-called advisor who's actually not managing your money, and there's a good likelihood you have a brokerage account, which about 90% of investors do. So again, do not falsely believe that your Wall Street firm or your broker-dealer, your advisor or broker is actually managing your money. You want to find out for sure, and one of the easiest ways to find out for sure is utilize our fiduciary versus suitability questionnaire. This way you can actually ask your current advisor or the firm that you're entrusting with your money to sign off as a money manager and as a fiduciary, meaning they are legally bound to work in your best interest and they're legally bound to manage your wealth, which includes risk management. You can get a free copy of that at reznywealth.com. That free report and questionnaire is entitled Fiduciary versus Suitability. Most investors falsely believe their advisor is actually managing their money when they're not. I know I said that earlier, but it's important for you to make sure you truly understand. Again, if you've ever been told, hold on, things will come back. If you've ridden the stock market all the way to the bottom, there's a good likelihood that your money's not managed. If you've been sold non-traded REITs, annuities, you own mutual funds, proprietary products from that firm that you work with, there's a good likelihood you have a brokerage account and your money's not actually managed at all. The failed Wall Street pie, asset allocation. If you've noticed this chart that shows up on your brokerage statement, chances are your money's not managed at all. And you have what's called the failed pie or asset allocation. Asset allocation basically is kind of like a garage. You collect a lot of stuff in your garage or investment assets, and basically one day you open the garage and everything kind of falls out. Not a lot of purpose for what's in the garage, and you haven't used it, and the values of a lot of the articles in that garage have gone down and not up. Asset allocation premise that is pushed by Wall Street banks and insurance companies, oh, we're going to spread your money out all over. The problem with that is weak assets drag down the portfolio for prolonged periods of time, hurting your retirement and your investment returns. Passive investing, set it and forget it, does not work. Let's talk about set it and forget it. Many investors believe that they can buy a basket of investments, let's say mutual funds, and 10 or 15 mutual funds, and they feel that they're diversified. They set it and forget it because, again, they thought their broker was going to watch those mutual funds and tell you when you should get out. Again, passive set it and forget it, asset allocation, lost a lot of money in 2000. It lost a lot of money in 2008. And statistically speaking, we're going to have another recession one day. We have them about every 6 to 7 years. We haven't had a recession in over 5 years. Are we due for another recession? Is the market going to sell off? What about the bond market? Will you lose money, or will you be proactive and have a sell strategy to manage the risk before your money goes down 30 to 50%? Passive investing failed in 2000 and 2008. Statistically, in 2000, equities dropped over 50% in the U.S. alone. Did you lose money in 2000? Did you ride it all the way down? In 2008, passive investing failed again. The equity markets again dropped over 50%. Statistically speaking, in recessions, equities drop between 35 and 50% in value, and it could be more. That usually takes between 12 and 18 months for most of those markets to bottom in a recession. Again, they get relatively weaker and weaker and weaker, and you, the investor who is a passive buy and hold, or you're repeatedly told by your broker, hold on, things will come back. Did that work for your investment portfolio, and is it going to work again when we do eventually have the next recession, or do you have a way to mitigate risk and have a way to determine when should you sell various assets in your portfolio? Recessions happen, and recessions matter for your portfolio. Again, statistically, we have recessions about every 6 to 7 years. Are we due for recession in the next year or two? Could be a chance. Now, while this economic recovery has been light, it may actually prolong the economic recovery for more years than the average 6 to 7. So what that means to you, the investor, is now is the exact time where you want to make sure you have a disciplined investment strategy, which includes when to sell risk assets, when to sell bonds, real estate, gold, or any investment in your portfolio. Blindly buying assets and putting them in your portfolio, like heaping garbage in your garage, only has a chance of losing your money long term, because if you own assets that are not appropriate for current economic conditions, you may ride those all the way to the bottom. Diversification is important. Don't get me wrong, but it's how you diversify. Too many investors think, I buy 15 or 20 mutual funds and I'm diversified. If all those mutual funds are equity-based, or half's in equity and half's in bond, and the bond market doesn't do well, half your money goes down for prolonged periods of time. If equities don't do well for prolonged periods of time, even though you own 15 mutual funds that are all equity-based, they're all going to kind of go down at the exact same time, meaning even though you think you're diversified, if they're all in the same asset category and you ride them all the way down, diversification is important, but not false diversification like asset allocation, which is you buy and hold assets, you ride them down for prolonged periods of time, instead of owning what's relatively strong in an uptrend and selling what starts to break that trend and selling weakness. You want to buy strength, you want to sell weakness in order to protect your overall portfolio from catastrophic meltdowns and recessionary calls that we often see in the U.S. approximately every 6 to 7 years. Asset allocation that failed pie. Let me tell you a quick story. I had just recently a client that hired my firm. He came from one of the brokerage firms. He thought the firm was a fee-only money management firm. And again, no brokerage firm, bank, or insurance company can ever be fee-only because they sell product. They earn commissions and underwriting fees and the like. So again, no bank, no Wall Street company, nobody who earns commissions can ever be a fee-only money management firm because, again, they have the conflicts and the cost and the brokerage side of their business. So anyway, this particular new client came in. He had an asset allocation pie that looked like this. He actually owned almost 30 mutual funds and ETFs in his portfolio. They were about half in stock and half in bond. They were almost all the same overlap of investments. He thought he was diversified, but when everything went down, unfortunately, his portfolio suffered greatly. So again, just because you own 10, 20, or 30 mutual funds doesn't mean you're diversified if they're all in the same asset category and they're all going down in a relatively weak market. I'm going to take a quick break. I'll be right back with more about real investment strategy and how you can protect your retirement and your portfolio from catastrophic loss. Hello, this is Brian Rezny, president of Rezny Wealth Management, a fee-only registered investment advisory firm. We have a special report just for you pre-retirees and retirees, how to avoid outliving your money during retirement. We cover the major pitfalls many smart investors overlook and leave money on the table. Go to my website, reznywealth.com, and get your free report. I hope you're joining today's program. By the way, go to my website, reznywealth.com. That's reznywealth.com. We'll have that at the bottom of the screen. Go there. Our website has great information. We've got 3 great reports for you. Our number 1 report is fiduciary versus suitability. The number 1 biggest risk you have as an investor is not understanding if your money's really managed and if your advisor or broker is taking advantage of your portfolio. Number 2, why annuities are dangerous to your wealth and your retirement. And our 3rd report, how to avoid outliving your money during retirement. All those reports are free. They're available on my website at reznywealth.com. You can also contact my firm for a consultation. If you're concerned that your money is actually not being managed, if you're realizing your so-called advisor is a nice person, they may remind you of your grandson or your child, but they're not doing the right job for your retirement portfolio, and you want to avoid catastrophic recessions, you want a real investment strategy which includes risk management, call my firm for a consultation. We do have offices throughout Florida, Naples, Fort Myers, Boca Raton, and Coral Gables. We would love to talk to you about your retirement and, better yet, your portfolio, and help to protect you and your loved ones so you can have a successful retirement without the added stress of managing your own money. Adaptive is key when you develop an investment strategy. At the top of our show, we talked a lot about, who really manages your money. Do you have an investment strategy? But the key is when you develop an investment strategy, or if you're hiring a firm to actually manage your money, you want to have what's called an adaptive investment strategy, meaning it can change as dynamics are changing with the economy and all the investment sectors. It's kind of like driving down Alligator Alley. You wouldn't drive your car in Alligator Alley, put your cruise control on at 80, go in the fast lane and take a nap for the next 80 miles. You still have to be alert, because all of a sudden there's somebody in front of you in the fast lane going 65. Adaptive driving is you'd put your foot on the brake, take off the cruise control, and coast around that person and go back into the fast lane. If you're like most investors, the problem with your strategy, it's not adaptive. You're always in stock or bond related investments because your advisor wants to keep you always in stock and bond related investments, even though they're not appropriate and they're relatively weak for prolonged periods of time as your portfolio continuously goes down in the next recession. We're going to have another recession. The question is when, and how can you judge recessions and start seeing relative weakness to know when to get out early before maybe you've ridden it down 40 or 50%. Again, the key is adaptive investment strategy, which allows you to change and migrate that portfolio into safer investments when it's appropriate, and to be in more growth investments when, again, those are appropriate or relatively strong in an improving economy. This picture really talks about adaptive and one-sided portfolios. Let me explain. You're clearly looking at a picture of a utensil drawer with a lot of utensils. If I put a bowl of soup in front of you for dinner, which utensil would be most appropriate? Clearly a soup spoon. But what asset allocation is you would have to use every utensil in that drawer to eat soup with evenly. How effective would your eating habits be if you had to use all the utensils in the drawer to eat a bowl of soup? You wouldn't be very effective, but you would be effective if you used a soup spoon. The problem with asset allocation, or the failed pie, is you have to use all the utensils all the time in your portfolio, even when they're not appropriate. Think about that, investors. Does your portfolio resemble the Wall Street failed pie? Does that show up on your brokerage statement? Are you buy and hold? Did you ride things all the way down in 2000 and 2008? Never got that phone call, it's time to sell? Chances are you're working with an advisor who's really a broker in a brokerage account, and your money's not managed at all. Relative strength versus relative weakness. At Rezny Wealth Management, we run a very strict investment strategy, and one of the ways that we pick investment asset categories is off relative strength, or performance off asset categories that come against each other. Instead of owning everything, we look at all investment categories around the world, not just stock and not just bond-related assets in the U.S., but all investment categories, including cash, inverse ETFs, commodity-based gold, equities overseas, treasuries. All these different asset categories go into our stable, as we call it. Out of that stable, we rank the performance on a relative strength basis. We want to own relatively stronger asset categories over certain time frames. When those categories start to get what's called relatively weak, we want to start selling those categories. What's interesting about relative strength and then relative weakness, if you think about 2008, when the stock market started to get weak, it didn't drop 50% overnight. It took about 15 months to get weaker and weaker and weaker. As that weakness starts to occur in about the third month or so, and you're starting to see outperformance from safer assets like cash or treasuries, that usually is an early warning sign you want to start reducing equity-based exposure. So by running a strict strategy off relative strength, you own those stronger assets, and sometimes that means owning a stronger asset means going to cash in order to protect your portfolio from going down 30 or 40%. Again, relative strength and relative weakness. You want to buy into relative strength. You want to sell into relative weakness as it's getting weak, usually about 3 months out, and you want to repeat the process. Look at all asset categories, own the ones that are stronger, not everything at once, because that can be a disaster for your portfolio, and all you're doing is going right back to what Wall Street has pushed for years, which is asset allocation, the failed pie. If the failed pie shows up in your portfolio or on your brokerage statements, give our office a call. There is a difference, and we would like you to experience it. Take a look at this next picture or chart. What we like to do is explain our strategy like a horse race. We look at all asset categories. Those are put in the stable. Not just stock and bond, but all different categories that are non-correlated, meaning non-correlated, some assets can go up when others are going down. We basically rank all those asset categories against each other, the strongest horses, and we typically own those top categories within our portfolio. As one of those categories starts to get weak, it's taken out of the horse race, or that horse is taken out, and a fresh horse from the stable is put back into the portfolio. By doing this, we can help alleviate or reduce major catastrophic risk because, again, we're not buying and holding equities all the way down. We're not just owning bonds or stocks together, but we're looking at all broad-based categories. While relative strength is not a guarantee to future performance, it sure is a great strategy to use to basically evaluate various asset categories, look how they are coming against each other, and which ones you may want to own in your portfolio based upon your strategy, and which ones are getting weak that you may want to consider selling. Again, adaptive is key, and objective in your portfolio strategy can help build you a more secure retirement. Phil in Naples, Florida. Brian, you have a great show. I'm with an advisor who only buys large cap stocks. In 2008, I lost 50% as we rode it all the way down. I'm nervous and I don't want to repeat 2008 as my advisor is buy and hold. Are you taking new clients? Phil, great question. Yes, our firm is taking new clients. We do deal with larger investors. Our account minimums are $500,000 on up, and we typically deal with larger investors. We would love to sit down with you, Phil, at either our Naples or Fort Myers office and talk to you about your portfolio, and we can definitely offer you a great review, consultation, and really take a look at what's going on in your portfolio. What's happening in general, from what you're telling me on your question, though, is who you're currently entrusting your money to is buying only large cap, it sounds like U.S. stocks. So what you're doing is, if you look at the universe of investing, which is huge, you're basically in one little corner of the investment world, or that's all the person you utilize is looking at. What about small and mid cap, which over various time frames have greatly outperformed large cap? What about real estate? What about oil? What about gold? What about inverse ETFs or maybe treasuries or different kinds of bonds when appropriate? So by looking at one only asset category, Phil, and only owning that category, the problem you're going to face is when 2008 comes around again, you're going to basically be buy and hold, and you're going to have all those equities go back down again. It might not be 50% again. It might be 30 or 40%, but at the end of the day, the strategy your person's running is one-sided, and it doesn't sound like there's a way to mitigate risk in severe recessions and down markets. You seriously should call my firm for a consultation. There is a difference, and I'd like you to experience it. Mike in Fort Myers, Florida. I have the failed pie asset allocation you described. My portfolio is $1.2 million, and I hold 25 mutual funds, basically equity-based. What would you do? Again, Mike, like my last caller who was all in large cap equities, if you're all in mutual funds, first off, owning 25 mutual funds, that's crazy, especially if they're all equity-based. All you're doing is overlapping. It's kind of like making a sandwich with 12 slices of bread on one side, a little lunch meat, and another 12 slices of bread on the other side. It's the same white bread, you're just watering down the taste of the lunch meat. The problem also is if all you're doing is buying and holding and owning equities, you're missing out on all the other asset categories around the world. Again, I would love to talk to you at one of our offices. Call my firm for a consultation. You can also visit our website to learn more about our firm and our investment strategy at Rezny Wealth Management. Dan in Naples, Florida. I have the problem of being an emotional investor. How do you know when to sell? Dan, many investors that either manage their own money or work with a brokerage firm tend to be emotional investors. And the reason is because people tend to ride things all the way to the bottom. What it sounds like, Dan, is you don't have an investment strategy, which includes when to sell. So like any successful person in the world, you need to develop an investment strategy, and criteria could be moving averages, relative strength or weaknesses I talked about earlier. You might look at a weakening economy and jobs reports as a way that you want to start selling equities. There's many variations of sell triggers within various asset categories. So again, not knowing what you currently own is hard for me to tell you when you should sell what you own. You need to develop an investment strategy which includes when to sell. If you can't do that, you don't have the time, discipline, or maybe just the knowledge, then you need to hire a real investment management firm like Rezny Wealth Management. I would encourage you to call my office for a consultation. We would love to talk to you about your portfolio and see if we can develop a more concise portfolio that will help alleviate your emotional attitude. Again, not only my last caller, but we get this call a lot from a lot of investors who've been sitting in cash, sold at the bottom of the markets, bought at the top. Emotional investing often drives investors' decisions, and investors who incorporate emotion into their decision making on their portfolio are often big losers of money and often big losers of return. So at the end of the day, what's your investment strategy? How do you know when to sell and control major down risk? Not these bumps in the road, but major catastrophic sell-offs in the value of your portfolio. That's what's important to you, the investor. If your goal is to have a successful retirement and you want to reduce investment stress so you can spend more quality time enjoying your retirement, call my firm for a consultation. The number's at the bottom of the screen. As I always say, our clients just enjoy retirement. They leave the heavy lifting to our firm to manage the money and control the risk. There is a difference. We invite you to experience it. Make sure you have yourself a safe and profitable day. Visit my website, reznywealth.com. We'll see you next week.